Operating leverage is associated with investment activities. It is caused due to the fixed operating expenses in the company. Operating leverage may be defined as the company's ability to use fixed operating costs to magnify the effects of changes in sales on its earnings before interest and taxes. Operating leverage consists of two important costs, which is the fixed cost and variable cost. When a company is said to have a high degree of operating leverage, if it employs a great amount of fixed cost and smaller amount of variable cost, the degree of operating leverage depends upon the amount of barriers cost structure. Operating leverage can be determined with the help of break-even analysis. As we fully understand what is operating leverage is all about, let's proceed to our example. So for the first example, Mark's company sells a hot dog for 30 pesos per piece. With variable cost of 12 pesos per piece, fixed costs are 30,000. So what I'm gonna do is create two different income statements for two different production levels or two different selling levels. The first one is going to be if we sell 2,000 pieces and the other one is if we sell 5,000 pieces. So we have the sale, variable cost, and when we subtract variable cost from sale, we have the contribution margin, then we're going to subtract fixed cost, and then we're gonna get the operating income. Operating leverage relates operating income. So what are the sales gonna be if 2,000 pieces were sold? So let's see. First, we will going to multiply the selling price from the production level which is 2,000. So for the selling price, 30 pesos per piece times 2,000 of production level, it will give us 60,000 pesos. And for the variable cost, which is 12 pesos per piece, we will going to multiply it also to production level, which is 2,000, so it will give us 24,000. So we will going to subtract the 2, and the difference will be going 36,000. 36,000 will be our contribution margin. And then for the fixed cost, it was already given, which is 30,000. So we're going to subtract it again to contribution margin and get our operating income of 6,000. Following the same process for the 5,000 pieces, this would be the income statement. Notice that fixed costs were the same because this income statement comes from one company, so that doesn't change. Only the sales, variable cost, contribution margin, and operating income. From here, we can get something called the degree of operating leverage. So what is the degree of operating leverage? It's basically the contribution margin divided by the operating income. In this case, the degree of operating leverage is going to be the contribution margin of 36,000 over the operating income of 6,000, which give us 6. So 6 is the degree of operating leverage to this production level. Then over here, the contribution margin is 9,000 over 60,000 of operating income. The answer is 1.5. Notice that the degree of operating leverage can be different from the same company. So the degree of operating leverage depends on sales level. Sales were different, so the degree of operating leverage was also different. So the same company can have different operating leverages or different degree for different sale amount. Another thing is, what if we increase the production level from this 2,000 pieces by 10%? So if we increase it by 10%, that will give us 2,200 pieces of production, or how many pieces we're gonna sell. So how's that gonna affect the income statement? So let's see. 2,200 times 30 pesos per piece, and that will give us 66,000 for the total sale. So for the total variable cost per piece is going to go up as well. So 2,200 times 12 will give us 26,400. If we subtract that 2, that will give us 39,600, and that will be our contribution margin. For the fixed cost, it will be the same because only the production level increased, so that it's still 30,000. Subtract the 2, and now for our operating income is going to be 9,600. So if we change the production level, everything on the income statement changed except for fixed cost. Now for this new income statement and old income statement, we will be calculating some things. So the first thing to calculate is the change in sales as a percentage. The percentage change in sales is equals to new amount minus old amount divided by old amount. So here are the formula. So 66,000 minus 60,000 over 60,000. So 66,000 minus 60,000 is 6,000 divided by 60,000. So that will give us 0.1. And that's in decimal. So if we convert it to percentage, we multiply that by 100, and that will give us 10%. As you can see, the change in sale was 10%, and that makes sense, right? Because if the production level went up by 10%, sales is directly correlated to that, so the sales is going to up by 10% also. Next is the change in operating income as a percentage. Well, same thing, new minus old divided by old. So this will be the formula. For the new operating income, which is 9,600, minus for the old operating income, which is 6,000, that will give us 3,600, and we will going to divide it by 6,000. So the answer is 0.6. Then we will going to convert it to a percentage, that will give us 60%. Notice that the sales went up by 10%, but the operating income went up by 60%. So how do this relate? Let's observe the degree of operating leverage. If we take the percentage in sales, multiply it by the degree of operating leverage of 6, we would get the percentage of change in operating income. Another way to look at the degree of operating leverage is basically the percentage change in operating income over percentage change in sales. So here are the formula. Degree of operating leverage is equals to 60% over 10%, and that will give us 6. This also works if these sales go down. Let's say the 10% is negative. So if the production level or the sales went down by 10%, then the operating income would go down by 60%. So for this one, we could show that here at the production level of 5,000. If it's go down by 10%, then we're gonna be producing 4,500 pieces. So how I get that? 1 minus 0.1 give us 0.9. So 5,000 times 0.9 will give us 4,500. So now we could fill out an income statement for that new production level. For the new production level 4,500, we will going to multiply it to 30. That would give us 135,000. And then the variable cost 12 pesos per piece times 4,500 pieces. So the answer is 54,000. Then subtract it, so the difference was 81,000, and that would be our contribution margin. For the fixed cost, it's still gonna be the same, 30,000, and then subtract it, and our new operating income will be 51,000. Observe that for this production level, we calculate the degree of operating leverage to be 1.5. For the sales percentage change in sales, we will have negative 10. And for the percentage of operating income, the formula is new minus old. So that is 51,000 minus 60,000 will give us negative 9,000 divided by the old, which is 60,000, and the answer will be negative 15%. See that these two relate by the degree of operating leverage, 1.5. Negative 10 times 1.5 gives us negative 15. Whether we are increasing by a certain percentage or decreasing, it doesn't matter because we could always use the degree of operating leverage. If someone asks you if what if the sale go up by 50%, what's the operating income? So for this production level, we would take the 50% multiplied by 1.5, and that would give you 75%. So it would go up by 75% operating income, versus here at this production level, if we increase the sale by 50%, well, 50% times 6 would give us an increased operating income at 300%. So it all depends on the production or the sales level of the company is currently at. And that is going to change the degree of operating leverage, and it's going to change the sensitivity of operating income relating to sale. Now, another thing I want to mention is another way at operating leverage is commonly looked at is in terms of fixed cost. And more specifically, the fixed cost as a percentage of sales. So see that the fixed costs here are 30,000. Sales are 60,000, so the fixed cost in this area is 50% of the sale. Meanwhile, in this production level, we will see that the fixed costs are still 30,000, but the sales are 150,000. So 30,000 divided by 150,000 gives us 20%. So fixed costs are 20% of the sale. Observe that the higher the fixed cost relative to sales, the higher the degree of operating leverage. A higher degree of operating leverage, the change in operating income is going to be more sensitive. It's gonna change more in percentage when the sales change. Let's move on for our next example. In this one, we will be showing two companies that have different cost structure. For company number 1, sales is 100,000, variable cost is 20,000, contribution margin is 80,000, fixed cost is 60,000, and the operating income is 20,000. For company number 2, sales is 100,000, variable cost is 50,000, contribution margin is 50,000, fixed cost is 30,000, and operating income is 20,000. These two companies have their income statement here. The sales are the same and the operating income are the same, but the cost structure are different. Meaning that company 1 has lower variable cost and company 2 has higher, while company 1 has higher fixed cost than company 2, which is 30%. For this company, it's going to be contribution margin over operating income, which is 4, while this company 50,000 over 20,000, so the degree of operating leverage is going to be 2.5. And that makes sense, right? Higher fixed costs is higher degree of operating leverage. Now the difference with what's going on inside of this company is, let's say this company is a car manufacturing. If you have car manufacturer that has lower variable cost and higher fixed cost, that means there's gonna be more machine or automation. Another thing that you may see mentioned is that this company is going to be more capital and machine intensive. So there's gonna be less people working there, and that leads to less direct labor. Meanwhile, for the company where the variable costs are higher for the same level of sales and the fixed costs are lower, that means there will be more people working there. And it led to more direct labor. It can be more labor intensive, so not as much automation, not as many machines in a company like that.
So now let's talk about how to use operating leverage and its importance to business or a company. So we need to be very careful when looking at operating leverage because it can tell you a lot about the company and its future profitability and the level of risk it offers to its investors. So even though operating leverage doesn't tell the whole story about the company, it certainly can help. So operating leverage reveals how well a company is using its fixed cost items such as warehouse, equipment, and machineries for productions to generate their profits. So Ms. Dobb already discussed what is high operating and low operating leverage, right? Wherein high operating leverage must cover a larger amount of fixed costs each month regardless of whether they sell any units of products. So, however, in low operating leverage, companies may have high costs that vary directly with their sales, but have lower fixed costs to cover each month. So, when using the operating leverage measurement, constant monitoring of operating leverage is very important for a firm having a high operating leverage, since a small percentage of change in sales can result in a dramatic increase or decrease in profits. So a firm must be really careful to forecasting sales in this kind of situation, since a small forecasting error translates into much larger errors in both net income and cash flows. So we need to be very knowledgeable with regards to the level of operating leverage because it can have a profound impact in pricing policy, since a company with a large amount of operating leverage must be very careful not to set its prices so low that it can never generate enough contribution margin to fully offset its fixed costs. Because we should always remember that in order to make a profit, the price must be higher than the break-even point. So I would like to ask, should our firm or my firm aim for a high or low operating leverage ratio? So in my opinion, low operating leverage is better than having a high operating leverage. Having said that, companies with a low degree of operating leverage may find it easier to earn a profit when dealing with a lower levels of sales. In addition, like in contrast, if you have a high operating leverage, you may be more vulnerable to changing macroeconomic conditions. Because in high operating leverage, if the company is in good shape, these firms may experience increased profitability. However, an economic downturn can lead to plummeting earnings due to their high fixed costs. So, can operating leverage be negative? Yes, operating leverage can be negative. And negative leverage shows that a company isn't making enough revenue to meet the costs. So, having said that, let's talk about the risk of operating leverage to our business. So, when a company assumes to apply operating leverage to improve its gross profit, it is exposed to a great risk. Although they can increase profits, an error in planning or execution can also generate significant losses for the company. This is because in an automatic processes, a small error can greatly impact the final products, since this error would affect each of the production stages. And I would also like to include that in a booming economy, having a high operating leverage level helps to maximize profits. Still, the market due to various factors can change, and in a country that is in crisis like Philippines, it can make sales levels fall, and the high level of fixed costs that the company possesses affects its liquidity and convert the result from profit to a loss. So, with regards to that, what are the main advantages of operating leverage to a company or to our business? So, one of it is it allows improving the company's utility in a highly efficient way, allowing the largest number of services and products not to have an impact that prices cost in the same proportion. Also, it helps the company to more accurately project and analyze its cash flows by taking into account the fixed costs it will pay during the year. And it also generates greater control over the costs that are incurred for production. So one conclusion companies can learn from examining operating leverage is that firms that minimize fixed costs can increase their profits without making any changes to the selling price, contribution margin, or the numbers of units they sell.
Financial leverage is primarily related to a firm's capital structures, mix of debt and equity. The presence of fixed financial charges in the firm income streams causes financial leverage. A company needs financial capital to operate its business. For most companies, financial capital is raised by being used the debt security and by selling common stocks. The amount of debt and equity that makes up a company's capital structures has many risks and implications. Therefore, corporate management must use a thorough and prudent process for establishing company's target capital structure. Financial leverage is the use of debt to buy more assets. So, financial leverage is the strategic endeavor of borrowing money to invest assets. The goal is to have the return on those assets exceed the cost of borrowing funds that is being paid for those assets. The goal of the financial leverage is to increase the profit of the financial leverage without requiring to have them use additional personal capital. This is very useful to the hands of the finance manager since financial leverage is unimportant as it creates opportunity for investors. This opportunity comes with the risk, and this is often advised that new investors get a strong understanding of what leverage is and what are the potential downsides before entering the leveraged positions. Financial leverage can be used strategically to position a portfolio to capitalize. The concept of leverage is very common in the business world. It is mostly used to boost the equity of the capital of the company, especially when a business is unable to increase its operating efficiency return and total investment because earning on borrowing is higher than interest payable on debt, and the company's total returning will increase, ultimately boosting the earning of the stockholders. Financial leverage can be favorable and unfavorable. It is positive when earnings are greater than that cost. However, it is negative when the company's earnings are lower than the cost of securing the funds. That of financing is an essential source of capital to support the limited investment of stockholders, and additionally, it helps to achieve the ideal level of return of equity.
Good day everyone, I am Larva Nadella San Pedro, and for today, I will be discussing what are we going to use in order for us to measure financial leverage. So for a company to measure its financial leverage, we are going to use the formula of debt to equity ratio. Debt to equity ratio compares a company's total liabilities with its shareholders' equity and can be used to assess the extent of its reliance on debt. So in simple terms, minimeasure ng debt to equity ratio kung kaano ba ka-safe or ka-risky para sa isang company ang mag-rely sa financial leverage for the company to continue operating. So the formula of debt to equity ratio goes like this. DE or D over E is equals to total debt divided by the total equity. So the total debt is the company's current liabilities and the total equity is the company's or the shareholders' equity. So for you to understand further, let me give you an example. I have here the balance sheet of the Apple Incorporated company, and it says here that the total liabilities of Apple is $241 million and the total shareholders equity or the total equity of Apple is $134 million. So distributing that or substituting that to the formula that we have, it will be $241 million over $134 million. Divide those, it will be 1.80. So, yung debt to equity ratio ng kumpanyang to is $1.80. It means na Apple had a $1.80 of debt for every dollar of equity. So, kung ang meaning ng result is 2 or higher, it might be risky kasi it means na nagre-rely na lang yung company sa debt to continue operating. So, in the long run, it can result to the bankruptcy or the failure of the business. But if the ratio is below 1, it is safe. Kasi mas lamang pa yung total shareholders equity kaysa sa total debt. Now, if the ratio is 1.5, it means na may kakayahan pa mag-operate yung business like Apple, it has 1.8. So, may kakayahan pa silang mag-operate ng business, but yung malaking portion na inutang nila, which is dapat mapunta sa income eventually, is napupunta lang sa expenses, like operating expenses, salary expenses, and etc. Now, if it is negative DE naman, it means na hindi lang malaki yung debt sa equity, but mas malaki na yung debt or yung liability kaysa sa total asset ng company. And in most cases, if this is the result, this can lead to business failure. But it is not all the time that it is advisable to rely on the result of the debt to equity ratio, because it varies according to the business industry that you're in. For example, if your business is construction company or airline company or financial bank and financial business sector, malaking sugalan yan. Malaking pera yung isusugal mo to start and to operate. So, many investors or many business owners that do have those kinds of business is na ngungutang muna talaga sila sa mas malaking bangko in order to start theirs. So, it means na yung nagpapagana sa business nila is yung inutang nila, and that is debt. And so, in that case, we can say na porket may utang ka or porket pinapagana mo yung business mo sa utang, masama na siya. What really indicates that your company is at risk is if steadily rising na yung debt to equity ratio na lumalabas kapag sinasolve mo yung financial leverage mo. it means na utang na lang yung nagpapagana sa business mo. And to make it simpler or to make it more compressed, parang may utang ka na, ang ginagawa mo pa is mangungutang ka ulit para ipambayad sa nautang mo na. So, wala ka ng income kasi napupunta na lang sa pambayad ng utang yung kinikita mo. Oo, nagre-run yung business. Oo, kumikita yung business. May assets ka pa, may lugar ka pa. Pero, most of that is napupunta lang sa utang mo and nagne-negative ka na. So, if that is the case, it will really result to you na loan default and for your business to fail.
So, upon checking and studying this topic, there are also advantage for the financial leverages, and I'm going to discuss it one at a time. For the advantages of financial leverage, first is it is very powerful to access the capital. Financial leverage multiplies the power of the dollar or peso you put. If it is used successfully, leverage finance can accomplish much more than you could possibly achieve without the injection of the leverage. Second advantages is that this is very ideal for the acquisition buyouts. Because of the additional cost that is used for bulking out for that, leverage finance is best suited for this period where your business has a specific growth objective, such as conducting acquisition, management buyout, and share buyback or one at a time dividend. Third is this increases the liquidity available to the company. This is very significant advantage of financial leverage because when a company takes out a loan or a debt, it receives cash from the lender, and that cash can be used for a variety of activity. These activities includes purchasing new machinery or constructing a new building, which will increase the efficiency of the company, or the company can use the cash to produce a new company, which will lead for it to have investment or in producing a money monthly, so that can actually one of the advantages, so you will earn more money for that. The last advantage of it is that the business can deploy more strategies for profitability, including streamlining processes, outsourcing, and integrating new technologies. Financial leverage offers an alternative way to increase profit by financing a portion of a business through loans or by issuing stocks. Although financial leverage carries risk, it can still provide a number of advantages.
So now, what are the disadvantages of financial leverage? Number one is it increases financial risk. Why? Because if you reach a point of high risk, it means that it will be hard for you to repay your debt. Parang ang nangyayari na lang nga is mangungutang ka para maipambayad mo sa inutang mo, and lalaki lang ng lalaki yung inutang mo hanggang sa hindi mo na mabayaran and maging default to loan na yung company. Another disadvantages of financial leverage is that it is more expensive for the company. Kasi alam naman natin na pag nangutang tayo, may interest. And mas malaki yung interest rate na inuutang ng isang company kaysa sa inuutang ng isang individual. And it means na kung magkano yung inutang mo, mas malaki ba doon yung babayaran mo. So it will be more expensive for the company. And lastly, it is more complex because it requires more time to manage and it involves many various risks.